Welcome to the Deep Dive, where we try to cut through the noise and get you, well, truly informed. Today, we're diving into really one of the biggest questions in tech right now. Can Intel Corporation, that's NASDAQ, INTC, can they actually reclaim their, once untouchable position in this new age of AI?
Hmm. Or is it possible the cracks in the foundation are just, well, too deep to fix? It's a really big question, especially when you look at where the stock is trading.
Exactly. As of July 1st, 2025, the stock's sitting at $22.85.
And our analysis, based on the sources you gave us, puts the estimated intrinsic value somewhere between, say, $21 and $25 a share.
So right in that zone, it really suggests the market sees it as, well, highly speculative, less a clear value play, more a big bet on a massive turnaround.
That's the heart of it. So today, our mission is to unpack all these complex forces. We're talking new leadership, fierce competition, the whole picture.
Yeah, we want to pull out the key insights, maybe some surprising facts, and just help you understand if this tech titan can genuinely recapture its former glory. We'll announce the chapter titles clearly as we go, starting right at the core, understanding Intel's business itself.
Okay, so Chapter 1, Business Analysis. Let's start with that fundamental question. Can a new CEO, a radical new strategy, actually let Intel reclaim its throne in the AI era? How does Intel even make money these days, and what's really changed?
Well, fundamentally, Intel's always been what's called an IDM, an integrated device manufacturer.
Right, they design and manufacture their own chips, control the whole process.
Exactly, in their own factories, their fabs. But that model evolved under the previous CEO, Pat Gelsinger, into something called IDM 2.0.
Okay.
It's got three main pillars. First, keep using their own internal factory network heavily. Second, use third-party foundries like TSMC more often for certain chips.
So outsourcing some manufacturing.
Some, yes. And third, and this is the big one, build up Intel Foundry Services, or IFS. That means making chips for other companies, even competitors.
Even competitors, potentially, yeah. It's a huge shift from being just inward-looking on manufacturing to, well, facing outwards, too.
So their revenue streams must be pretty broad then.
Oh, absolutely. Their client computing group, CCG, that's the chips in, everyday PCs, that's still the biggest slice of the pie.
Right.
But the strategic focus, the big investments, they're heavily skewed towards data center and AI, DCAI, and of course this new Intel Foundry Services.
And they sell chips directly to OEMs like Dell, HP.
Yep, direct sales to OEMs, data centers too. Plus they get licensing royalties, and then there's revenue from diverse areas like IoT, AI accelerators, and their mobile unit for self-driving tech.
Okay, and the actual products. We know the CPUs, the core processors, Xeon for servers.
Those are the icons, for sure. But strategically now, you have to look at their push into AI with the Gaudi accelerators.
Sure.
That's a direct challenge to NVIDIA.
A big one.
Huge. And they're also competing in discrete graphics with Intel Arc, taking on NVIDIA and AMD there too. Plus networking gear, FPGAs, software tools like OneAPI, and critically, IFS, offering up their manufacturing.
Let's talk market position, though, because this is where the story gets pretty dramatic. Intel was the king of x86 CPUs, right? The whole Wintel era.
Absolutely dominant. In 2023, they still held, 68.4% of the x86 market? But that dominance is definitely eroded.
And in the foundry space, where they're trying to grow with IFS.
That's where the contrast is stark. TSMC has a staggering 62% market share. Intel's share under this Foundry 2.0 banner was just 6.5% in Q1 2025.
Wow, 6.5% versus 62%. That really paints a picture of the mountain they have to climb.
It really does. It underscores the massive challenge. Historically, their value prop was simple: cutting-edge, reliable chips. Intel Inside meant quality.
Right.
But with IFS, there's a new value proposition emerging, and it's crucial. It's about being a resilient, geographically diverse, U.S.-based alternative to manufacturing concentration in Asia.
Ah, the geopolitical angle. Supply chain security.
Exactly. Driven by security concerns, geopolitical alignment. It's actually kind of a surprising lifeline for them, this government-backed aspect.
And the semiconductor market itself is just huge, right? And growing.
Oh, enormous. Valued at over $680 billion in 2024, projected to maybe hit $2 trillion by 2032. Some say $1 trillion by 2030, $2 trillion by 2040. The numbers are massive.
What's driving that growth? AI, I assume.
AI is a huge part of it. Generative AI chip sales alone could top $150 billion in 2025. Plus data centers, cloud, automotive, IoT. Even PCs and smartphones are seeing a bit of a recovery.
But it's a cyclical industry, you mentioned.
Extremely cyclical, 9 downturns in the last 34 years or so. It's definitely not a smooth ride upwards historically.
And the competition, you said it's fierce?
Fierce is an understatement. It's one of the most competitive industries, period. Intel's fighting a war on multiple fronts.
Who are the main players they're up against?
You've got TSMC, the foundry giant, 62% share, leading edge tech. NVIDIA, completely dominant in AI GPUs. AMD, chipping away constantly at Intel's CPU share, often using TSMC to do it. And Samsung, another big IDM, competes in foundry, but seems to struggle with yield sometimes.
So battles everywhere.
Pretty much. And then you layer on the regulatory environment.
Which is becoming very geopolitical.
Highly geopolitical.
Yeah.
You have the U.S. CPS Act, $52 billion in subsidies. Intel could get up to almost $8 billion of that. The EU has its own CHIPS Act.
Right, boosting domestic manufacturing.
Exactly. But then you also have strict U.S. export controls on advanced chips going to China, environmental regulations. It's a complex web.
It sounds incredibly difficult to even enter this market. The barriers must be huge.
Astronomically high. You need over $20 billion for one new fab. R&D costs are massive. Intel spent $16.5 billion in 2024 alone.
Wow.
Plus, you need incredible economies of scale, you need a ton of intellectual property, and there's a global shortage of the specialized talent you need.
Yeah.
It's really not for newcomers.
So given all that, what advantages does Intel still have? What are their strengths?
Well, brand strength. For one, Intel Inside was genius. It turned a component into a household name. That equity still matters.
Okay, that makes sense. What else?
Their sheer scale, their global fab network. That helps with buying materials in bulk, spreading fixed costs. Though, as you said, TSMC's dedicated foundry model really challenges that cost advantage now.
And switching costs. Is it hard for customers to leave Intel or for Intel Founder Services to win new customers?
It's significant, yeah. It can take over a year to move a complex chip design from one foundry to another. So that helps retain existing customers.
They've touched both ways.
Exactly. It makes it tough for IFS to poach customers who are already comfortable with TSMC or someone else.
So what's their most unique asset right now, would you say?
I think, especially today, it's their status as a large-scale, U.S.-based leading-edge IDM. This sort of geopolitical moat is increasingly valuable.
Because of the supply chain worries.
Precisely. In a world worried about supply chains and geopolitics, being the big American player, backed by things like the Cheech EPS Act, that's a powerful, unique asset, even while they're fighting to catch up technologically. It's a surprising edge, really.
That geopolitical angle is interesting, but for a company facing this kind of challenge, leadership is absolutely critical. So let's move to Chapter 2, management evaluation. Intel got a new CEO recently, right? Lip Bhutan, appointed March 18th, 2025.
That's right. And his background is a big part of the cautious optimism around Intel now. He's an external hire, highly respected industry veteran.
What's his track record like?
Well, two things really stand out. First, he turned around Cadence Design Systems. He was CEO there from 2009 to 2021, and the stock went up something like 3,200% during his tenure.
Wow, 3,200%. Okay.
Yeah, phenomenal turnaround. Second, he's also a venture capitalist, founded Walden International. They say he has a Rolodex like nobody else's. Gives him a really unique perspective on the market, on innovation.
And how has he responded to the crisis at Intel since taking over?
Immediately and decisively, it seems. There's this ongoing strategic review of their next-gen 18A process node. He's even considering a very costly pivot, maybe skipping ahead to 14A to try and leapfrog the competition.
18A, 14A, these are the node sizes, right?
What?
Smaller number means more advanced.
Exactly. Smaller means denser, more efficient chips. Jumping to 14A would be a massive gamble, incredibly high risk, high reward to try and regain that tech leadership.
Sounds bold. Is he shaking up the team too?
Seems so. He's trying to reshape the culture, flatten the structure, really refocus engineering on execution. The team now is a mix of longtime Intel folks like the CFO David Zinsner and key external hires like Dr. Sachin Kadi, who's the new CTO and AI officer.
So bringing in outside perspectives.
Vital. You need that blend of internal knowledge and fresh thinking. And Tan seems very committed to transparency.
How's that?
He talks about radical transparency. He was very blunt, acknowledging the 2024 performance fell short, so there were no excuses. That's a different tone than maybe we've heard from Intel in the past.
And ethically, any focus there?
Well, they publicly commit to corporate responsibility. They developed the world's first conflict-free microprocessor, which focuses on ethical sourcing of materials. That's part of their image.
Okay, let's talk money. Capital allocation. How are they spending their cash now? big shift there, too.
Oh, a dramatic shift.
Mm-hmm.
They've pivoted hard away from returning cash to shareholders, like dividends and buybacks, towards just aggressive reinvestment in IDM 2.0.
Building those new fabs.
Exactly. CapEx is projected at $18 billion for 2025 alone.
Yeah.
Massive spending. They've made acquisitions before, Altera, Mobileye, Habana Labs for AI, but they actually spun off Intel Capital, their venture arm, earlier this year to sharpen focus on the core business.
And the dividend, that got cut, right?
Sharply. February 2023, they called it a reset. Slashed the quarterly payout from over 36 cents down to 12.5 cents. So annualized, it went from about $1.46 down to just $1.50.
Big cut to save cash for investments.
Precisely. They said it was a deliberate approach to fund the transformation, and share buybacks pretty much stopped altogether.
So with all this investment and strategic change, how are their returns looking? Like return on invested capital, is it paying off yet?
Well, that's the painful part right now. ROIC has basically collapsed. It's deep in negative territory. For the 12 months ending March 31st, 2025, it was Medigas 12.33%.
Minus 12%. Ouch. Down from what?
Down from healthy numbers like high teens, low 20s, just a few years back, 2019, 2021. It really shows significant value destruction recently, which frankly justifies why they needed such a radical overhaul.
Okay, Chapter 3. Financial analysis. Let's dig into the numbers, the raw health of the company. Market cap first. Where does Intel stand now?
Right now, as of July 2nd, 2025, it's around $99.67 billion. Call it roughly $100 billion.
Which sounds big, but it's way down from its peak, right? Wasn't it near $500 billion at one point?
Yeah, during the dot-com peak, it was close to $500 billion. So a really dramatic contraction over the long term, showing that erosion of value.
And revenue growth. The last 5 years haven't been great, I take it.
Yeah. No, definitely not. Over the last 5 years, it's actually a negative compound annual growth rate, minus 5.9%.
Negative TGR. Oof.
Yeah. Revenue peaked in 2021 at about $79 billion. Then it dropped sharply down 20% in 2022, another 14% in 2023. It moderated a bit in 2024, down just 2%, landing at $53.1 billion. But getting back to sustained growth, that's still the major hurdle.
And those revenue drops must have crushed margin.
Absolutely crushed them. Gross margin, which used to be consistently above 55%, was down to just under 33% jab for 2024.
Wow.
Operating margin, even worse, collapsed from positive 30% in 2020 to negative 22% jab in 2024.
Negative 22%. So they're losing money on operations.
Significantly, which means the net margin is also deep in the red. Negative 36% for the trailing 12 months ending Q1 2025. It's a money-losing operation right now.
And that must show up in free cash flow, too.
Big time. It swung wildly.
Yeah.
Back in 2020, they generated nearly $21 billion in free cash flow. Fast forward to 2024, and it was negative $15.66 billion.
From plus 21 to minus 15. Huge swing.
Two things. Operating cash is down because profits are down, and capital expenditures are way up, almost $24 billion in 2024 to build all those new fabs. Cash going out faster than it's coming in.
How does their overall financial stability look if you look back, say, 10 years?
Well, the 10-year picture shows how dramatic the shift has been. For years, Intel was just a consistent profit machine, rock solid. But after 2021, things really turned south. 2024 saw that net loss of nearly $19 billion, EPS minus 4.88 cents. It's not just a blip, it's a major shift they need to reverse.
Are they taking on more debt?
Yeah, their debt-to-equity ratio has been climbing. It was 0.42 in Q1 2025, up from around 0.40 back in 2021. They're relying more on debt as equity shrinks due to losses.
And short-term health, or current ratio.
That's tightened too. It was over 2 back in early 2022. Now it's down around 1.31. Still okay, not alarming yet, but it shows liquidity is getting tighter. And that dividend cut we mentioned. Another clear signal they're focused on conserving every penny.
Okay, valuation. This is tricky when a company's losing money. PE ratio is useless, right?
Pretty much. It's negative, around money to 5.1x because earnings are negative, which is obviously a world away from their historical PE in the low to mid-teens or competitors like NVIDIA at 55x or AMD over 100x.
But you mentioned a dichotomy. Price to sales looks different.
It does. On a PS basis, Intel looks, well, relatively inexpensive at about 1.74 times sales. Compare that to AMD at 11x sales or NVIDIA at 30x sales.
So the bulls see cheap revenue, the bears see revenue that doesn't make profit.
That's the tension exactly. Which brings us to intrinsic value, using a discounted cash flow or DCF model.
Right, estimating value based on future cash flows, which must be super speculative here.
Extremely speculative, because you have to make huge assumptions about the turnaround. Our educational DCS model, based on the sources, spits out a range of $21 to $25 per share.
Okay, low 20s, similar to where it's trading.
Pretty much. Some analyst models reference, like Trefis, are near the top end, $25. Fintel's average was $21.63. But, if you just plug in the current negative cash flows without assuming a recovery, some models literally give you a negative value, which is mathematically possible but unrealistic. Just shows how sensitive this is.
And those assumptions are the whole ball game. What needs to happen for the DCF to work out positively?
Basically, you have to assume that negative free cash flow turns positive in, say, a year or two, and then starts growing steadily, maybe 2 to 2.5% long term.
And margins have to recover dramatically.
Dramatically. From deep negative territory now, you'd need to see them climb gradually back towards maybe that aspirational 40% operating margin goal they've talked about,
Yeah.
which most see as a very optimistic right now. You're essentially modeling a future success story that hasn't actually happened yet.
Okay, so the financials paint a tough picture, but with a path to recovery if everything goes right. Let's move to Chapter 4, Market Sentiment. How is the market, Wall Street and the media, actually feeling about Intel?
Well, Wall Street analysts are deeply divided. The consensus rating is a firm hold, meaning out of, say, 91 analysts covering the stock, you've got 19 buys, a whopping 49 holds, and 23 sells. That big chunk of holds isn't just lukewarm support. It suggests most analysts think the risk-reward is too balanced or the future just too cloudy to make a strong call either way.
And the price targets reflect that division.
Absolutely. The average one-year target is somewhere between $21 and $22.42, which is actually slightly below where the stock is trading right now. But the range of those targets is incredibly wide. The low is down at $14. The high is way up at $62.
Wow, $14 to $62. That's huge.
It perfectly captures that huge uncertainty, the vastly different potential outcomes analysts see for this turnaround.
What about the general media narrative? Has that shifted?
It has, somewhat. It's moved from mostly focusing on the crisis and the delays to more cautious intrigue. The dominant theme now is new CEO, new strategy.
Focusing on Lip-Bhutan.
Very much so. And specifically that potential pivot from the 18A to the 14A node. It's framed as this bold, high-risk move, but maybe necessary. There's definitely optimism around Tan himself, but it's always tempered by reporting on the financial struggles and the sheer difficulty of executing this plan.
Okay, what about market indicators? Short interest, for example. Are lots of people betting against Intel?
Actually, no, not really. Short interest is moderate, around 2.61% of the float. That's below average for its peer group.
Interesting. Why so low, do you think?
Well, the days to cover ratio is also low, about 1.6 days. It suggests it's not a high conviction short. Maybe traders feel it's just too risky to bet heavily against a company with this kind of government backing and a new respected CEO. Or maybe the turnaround story has just enough credibility.
And technically, how does the stock chart look? Moving averages.
Technically, it's showing some positive signs recently. The current price, $22.85, is trading above its 50-day moving average.
Yeah.
That's generally seen as bullish in the short term. And perhaps more significantly, it also recently crossed above its 200-day moving average. That's a longer-term trend indicator that many analysts watch closely. Crossing above the 200-day is often interpreted as a pretty significant long-term bullish signal.
So growing market optimism maybe, even if the financials haven't quite turned the corner yet?
It seems that way. The technicals are reflecting hope, even as the fundamentals are still challenging.
All right, Chapter 5, ownership structure. Who actually owns Intel shares right now, and what does that tell us?
Well, like most huge companies, it's heavily owned by institutional investors. Big funds, pension plans, that sort of thing. They hold about 64.5% of the stock.
And how many institutions?
Over 3,000 institutional owners. The top three are the usual suspects: BlackRock, Vanguard, State Street. A lot of that is likely passive index funds just tracking the market.
But what about the active managers, the ones making deliberate bets? Are they aligned?
Not at all. That's where you see the same division we saw with analysts. You have examples like Capital World Investors massively increasing their stake recently, up like 583%.
Buying big.
Buying big. But then you have Morgan Stanley dramatically slashing their position, down over 50%. It really highlights these high conviction bets being made on both the bull and bear sides of the story.
What about insiders? Management, directors, do they own much?
Very little, actually. Insider ownership is low, somewhere between 0.1% and 0.25%. That's not totally unusual for a mature company this size, but it's not high.
And are they buying or selling?
Mostly selling, historically. Over the last 12 months, the pattern is something like 3 buys versus 40 sells. More recently, in the last 3 months, it was 0 buys and 8 sells. generally a bearish signal from insiders.
But wasn't there a counter signal from the new CEO?
Ah, yes, and this is critical. Despite that general insider selling trend, the new CEO, Liputan, made a very significant personal investment when he took the job. He bought $25 million worth of Intel stock.
$25 million with his own money.
Exactly. That's a huge skin-in-the-game commitment. It directly aligns his financial interests with long-term shareholders, and it's a really important part of the bull case narrative, a strong countersignal to the other insider activity.
So overall, ownership is widely spread out. No single controlling entity.
Very diffuse, yes. No single shareholder has dominant influence. Management is ultimately accountable to that broad base of thousands of institutional and retail shareholders.
Okay, let's pull this towards a conclusion. Chapter 6. Risk assessment. Time for a classic SWOT analysis: strengths, weaknesses, opportunities, threats. What are Intel's core strengths?
Well, even with the recent struggles, they still have a formidable technology portfolio, tons of valuable intellectual property and chip design. The Intel Inside brand, as we said, still has huge global recognition and power. Their manufacturing scale and that integrated IDM model, even under pressure, are for potential synergies. And it's the foundation for this whole IDM 2.0 strategy. And, crucially, decades of past profits mean they still have a relatively strong balance sheet, giving them the financial muscle to actually fund this incredibly expensive turnaround.
Okay, but the weaknesses are pretty significant too. What stands out most?
Without doubt, the biggest weakness has been manufacturing execution failures. Those repeated delays in getting new process nodes out the door, the fact they're still reviewing 18A. That's been the core problem.
And that led to?
That directly led to the collapsing profitability and the negative free cash flow we talked about. Plus, they were arguably slow to react to the rise of GPUs for AI, which let NVIDIA build such a dominant lead in that critical market. So lagging in AI is another key weakness.
All right, opportunities. Where's the upside potential?
Well, the AI market itself is explosive. If Intel's Gaudi accelerators or future integrated AI chips can gain traction, that's a massive opportunity.
And the foundry business, IFS.
Huge potential there. It opens up this multi-trillion-dollar market. And it has those geopolitical tailwinds we discussed. The GAPS Act support, the demand for geographic diversification. That's a major strategic opportunity.
Any others?
Yeah, diversification into other areas like automotive, through Mobileye, networking, edge computing, those offer growth too. And of course, the biggest opportunity is simply the potential for this new leadership under Liputan to successfully execute the strategic reset and fundamentally transform the company.
Okay, now the threats. What external factors could derail this? Competition, obviously.
Intense, capable competition on all sides. TSMC and manufacturing, NVIDIA and AI, AMD and CPUs. Plus, there's this trend of big customers, Apple, Amazon, Google, designing their own chips in-house, reducing reliance on companies like Intel.
Insourcing, right.
Cybersecurity is a constant threat for any tech company. And that global talent shortage in semiconductors could definitely hinder their plans to build and staff all these new fabs quickly.
What about macroeconomic threats, interest rates, inflation?
Very sensitive. Higher interest rates make borrowing billions for new fabs more expensive. Inflation pressures are already weak margins. And being cyclical, any major economic downturn would hit demand across PCs, data centers, everything.
And geopolitical threats, beyond the supply chain issues that might actually help IFS.
Well, the U.S.-China tech rivalry is a big one. Export controls could disrupt things further or cut off markets. New tariffs or trade wars could raise costs. And then there's the sort of systemic risk around Taiwan.
If conflict disrupted TSMC.
It would be catastrophic for the whole industry.
Yeah.
But, ironically, that very risk is also a key justification for supporting Intel's U.S.-based foundry. So it's a threat that, in a strange way, also reinforces one of Intel's strategic opportunities. A real double-edged sword.
All right, Chapter 7, Conclusion. We have covered a lot of ground. Let's try to synthesize this. If you had to sum up the core bull case for Intel, what would it be?
Okay, the bull case hinges on, I'd say, 4 main things. 1, new, credible leadership with Liputan, who has a great track record and a bold plan. 2, those powerful geopolitical tailwinds, GAPS Act, national champion status, supply chain diversification needs.
Right.
3, huge market opportunities, especially in AI and potentially in that multi-trillion-dollar foundry market with IFS.
Right.
And 4, the idea that despite the current losses, the underlying assets might be undervalued, especially on metrics like price to sales, and they still have a decent balance sheet to work with.
Okay, makes sense. Now, flip side, the bear case. What are the biggest risks?
The bear case is also strong. First and foremost, monumental execution risk. Can they actually deliver 5 nodes in 4 years given their recent history of delays? That's the billion-dollar question.
Maybe trillion-dollar question.
Maybe. Second, the competition isn't standing still. TSMC, NVIDIA, AMD, they are incredibly tough, entrenched rivals. Third, the financial situation is dire right now. Deep losses, burning cash, profitability is highly uncertain. And fourth, the risk that this is a value trap, that the low valuation reflects permanent damage, that margins won't recover structurally.
So bringing it back to valuation, our educational DCF model gave that range, highly speculative, of $21 to $25 per share.
That's right, emphasizing again how dependent that is on assuming the turnaround actually works.
And the current stock price, as of July 2nd, 2025, is $22.85.
Sitting smack dab in the middle of that estimated intrinsic value range.
Which really suggests the market's got it about right.
It suggests the market has priced the stock pretty efficiently, yeah. It seems to be balancing those significant risks of failure against the potential rewards if they actually pull off this incredibly difficult turnaround.
So investing in Intel today isn't like buying a stable, predictable company.
Not at all. It's really a highly speculative long-term wager. You're betting on this specific management team under Liputan to execute one of the most complex corporate turnarounds we've seen in a long time.
And success hinges on fixing internal problems before external shocks hit.
That's a good way to put it. Can they solve their own execution challenges? The manufacturing delays, the path back to profitability before a major recession hits, or some geopolitical crisis throws another wrench in the works. That seems to be the critical race against time.
So for investors, it depends on risk tolerance.
Absolutely. If you have a high tolerance for risk and you believe in the strategic importance of having a strong, leading-edge American semiconductor champion and you believe can deliver, then the potential upside from here could be very significant. But the risks are equally substantial.
A fascinating high-stakes story indeed. What stands out most to you about Intel's future? Let us know. And for more deep dives like this one, please do like and subscribe to the Stock Analytics AI YouTube channel.
That's right. And remember, members can suggest stocks for future deep dives right there in the comments. We do pick them up. For just €4.99 a month, members get priority access to our deep dives. We're planning to cover all of the S&P 500 stocks over the next few months, and members get that exclusive priority access.
And if you just want a one-off deep dive on a specific company you're interested in, you can always drop us a super thanks.
And finally, the important reminder. This analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice.
Please, always do your own research or consult with a qualified financial advisor before making any investment decisions.